All right, here with Max Leaman talking about the interest rates going up. So what happened last week with the Fed?
Well, so the Fed raised the rates, the Fed fund rate, 50 basis points. That was the first time in 20 years they raised it that much. Also, from what I'm seeing, they could do 3/4 next month. When back when the Fed kept cutting the rates, we would have this conversation. I think I even got on here one time with you where we talked about, just because the Fed cuts the Fed rate doesn't mean that mortgage rates are necessarily going down.
Mhm.
At the same time, with them raising the rate, it doesn't necessarily mean mortgage rates are going to immediately get worse. A lot of this stuff is already priced in. The Fed's putting out notes and memos, and all these guys are talking. And so you kind of, for the most part, have an idea what's going to happen. The market does when they go into these Fed meetings. So as long as everything happens the way that it's supposed to and the way that they said it's supposed to, you don't typically see much of a reaction.
Yeah.
When the Fed comes out and says something that the market wasn't expecting, that's really when the reaction starts. So we had known for a while that rates were going to be, that they were probably going to increase everything, 50 basis points. Fine. They came out, didn't say anything unusual. The market actually, we saw a little bit of improvement that day. And then Friday, we were right back to where we've been for the last 3 months, where we were now down another 60 basis points or so. To put some perspective on that, in a normal environment, mortgage-backed securities will change 3 basis points, 5 basis points a day, not much. If you see a 10 or 15 point swing, you're like, okay, and 25 is a lot. Back when everything started in 2020 and it was going crazy, we were seeing swings of, and if you'll remember, there was times one day the rate was 3.875 and the next it was 3.5. And then the next day it was 4 and nobody could keep up. Sometimes it changed in an hour and you were seeing these 60, 70, 80, 90, 100 basis point swings. That's kind of what we've been seeing for the last 60, 90 days
Mhm.
is, the market, we're down 30 basis points. We're down 40 basis points. We're down 80 basis points. I think there was a day, week before last, we were down close to 95 basis points on the day. They just keep getting worse and worse and worse.
So what does that mean for your average borrower? If they're, let's say they're looking at a $500,000 home, and I mean, what is the rate right now? Like 5.2 to 5.7?
Yeah. So the average rate as of today, and I always follow mortgagenewsdaily.com. There's a section on there for the average rate, and it's the average rate essentially with points baked in. So it's basically the APR, which is always higher than the note rate. So if you look at that, APR today is 5.52, which is basically a rate of 5.375 with a point or a point and a half on there, right? So you're looking at somewhere between 5.375 and 5.75 for rates today. I talked to a gentleman earlier. He was looking at an $800,000 mortgage. When we started last year, the rate was 3%. Now he's not ready to lock in today, but jumbo rates are better than conventional rates, right? So roughly, if we could do a 30-day lock today, he'd be at 4.75. So we ran a scenario of 5% just to see what that's like. I mean, he's not closing till September, so he's got problems anyway. But his payment was $1,000 more.
Wow.
And so that's 2 points on 800,000. I mean, it's a problem. And we've seen people that are under contract on new builds that no longer qualify because they were already tied on debt to income. And now that it's time to lock, it's out of their affordability range. So, I mean, you're definitely seeing that.
Yeah.
I'm getting more and more calls from realtors asking what we're seeing. Are you busy? What is it? I mean, I have this conversation probably 4 times a day between loan officers and realtors. We're all seeing the same thing.
Yeah.
And I think Chris's housing report on Facebook it's spot on.
Yeah. We're talking to him next.
Yeah, I see him. I see it on our end exactly what he's saying.
Yeah. Yeah. So, gosh, there's such an increase in mortgage payments. And, you know, from my part of it, what we're seeing is, okay, you know, it sucks for the people that can't afford it, but the people that can, you know, this is a good thing that there's not as much competition. We're seeing more inventory in the market, you know. No, they're not going to get $100,000 in an equity in 3 months like everyone else did, but you know, at least they won't have to fight as hard for their home. And you still have to keep things in perspective. Is that, you know, under 6%? I mean, my first mortgage was like 7.5, I believe, something like that. You know?
Oh yeah, and you know, we've been spoiled for a long time. You know, these rates haven't been. The last time rates were at these levels were 2009 and before.
Yeah.
Rates haven't seen this. The sticker shock is a different thing, right? Like this, the rate, the velocity at which they are going up hasn't been. It's been since I believe it's 1994.
Yeah.
Right. So we've lived in this essentially 20-year bubble or 10-year bubble, really, I guess, where rates have been so low for so long. We've all just been spoiled.
Yeah.
Right. And now everybody's got sticker shock. You know, when you go, I'm just pulling up a chart here. When you look at loan applications, I mean, loan applications are down quite a bit. We're seeing it week after week. We have less applications coming in, less inquiries coming in. Now, more people, we've got a lot of people backlogged trying to get properties under contract.
Yeah.
So we still have contracts coming in, and we're seeing more and more of those, I think, based on the data that I've got. But you know, the last 3 weeks, leads have been down.
Yeah. Right.
And I don't know that that's going to stop anytime soon. You know, I think I think we're in for more pain before things get better.
Well, right. I think if the agents were smart, they'd be looking at the leads that came in, you know, a year ago, that, you know, instead of chasing the ones that came in, you know, yesterday, and the ones that they've been cultivating with their newsletter, with their, you know, property alerts, stuff like that.
Yep.
You know, that's what we're trying to teach. Anyway, well, I appreciate it, man. That was really helpful. And you know, I might reach out to you next month and we'll do it again.
Oh, thanks for having me.